G'day everyone, it's Bruce from the Joinery Coach. I get a lot of questions, I get a lot of people contacting me, asking me about how they can afford to get our help. And also the other question I get a lot is, how do I get maximum profit? How do I make the most out of my business? Two very good questions, right? They're probably the most important underpinning questions anybody could ask in business. And I encourage everybody that runs a cabinet making or joinery business to ask those questions. But don't just ask the questions, like look for the true answers and look for good, valuable input as to who can provide you with those answers. So I thought what I would do today is I'd provide you with a little bit of a snapshot, an actual numbers game to show you a client. So this is a real client that we've worked with, and what their numbers look like, what their numbers look like before we worked with them, and after we started working with them, and the projection into this year, what we're projecting to see happen this year. And I'm also going to talk just a little bit about the fact that everything in business is an investment. Every single thing you do in business is about you investing your money into something. So you might take your money, your own personal money, whether it's cash that you've saved or have somehow, or a loan that you've got from somewhere, and that's your money, and invest it in your business. Or you might consider taking the revenue that the customers give you, that's money that you're getting, and you're investing it in something. So you're investing in materials and labor and all those other things in business. So no matter where your money comes from, let's think about how are you investing that and what is the return on your investment getting you. Now, if you're a business that is struggling to make profit, clearly your investment is not paying you back. Something you're doing isn't working. So let's go through this little spreadsheet. So the one thing I also want to make clear, and I'll pause for a second, I just want to make this clear. The numbers that you're about to see have not been reconciled and verified. So if there are any mistakes, we're not showing you the actual accounting package snapshot. This has been extracted out of that and put into a spreadsheet so that you can see it, and we're not going to share any private company information as to where it came from, but it has been put into a spreadsheet, and as Excel spreadsheets go, there may be a little glitch here and there. So if any of you find something that's glitchy, let me know and we'll fix it, but I think this is pretty close. So we'll just run down the numbers here, shall we? This 23-24 year was this particular client before they started working with us. And as with a lot of businesses, let me just make this a little bit larger. As with a lot of businesses, they have their revenue coming in. Obviously, that's their revenue coming in. And they really only had one revenue source. This was work from builders. 2023, 24, that was when, certainly COVID was over and everybody was kind of getting back on track. But the risk in this business was they were getting one revenue source. And they had no investment in things like, let's look at things that they didn't invest in that they probably should have. Things like marketing. They put a little bit of money into maybe boosting a post on Facebook and stuff like that, but it really wasn't working for them. But you can see here that their gross profit, which is their total revenue, less what it costs you to make your product. So that's your materials, your labor, and all that sort of stuff. There was only 22% of the revenue left over. So their investment was only leaving 22% of the gross amount. Now, of course, you've got business overheads to take out of that, so we're not done yet. But you can also see the numbers here that when we look at the percentages, 42% was what was costing them for materials. So we know that number right there tends to indicate how well their pricing system is working. So we as a coaching team would look at that and say there's an opportunity to fix your pricing system. But we also look at these numbers here, which is the direct labor cost. So that's either going to be on wages or it's going to be subcontractors. And we can see here that this cost is something in the order of about 34%. So 34% of all the revenue that was coming in was being invested in humans to make product. And so we're going to talk a minute about how they get that investment back. But it's too high. That indicates that this business is really inefficient. So if you were to come to me and show me these numbers, the first conversation we're going to have is we need to work on your efficiencies. We need to get work out the door faster so that you can get paid faster. But as you can see here, the end result for this business was a lot of money being spent on things that didn't get them a return. And in the end, the business itself made a net profit of about $111,000. But as you might know, if you're taking drawings, you're probably going to say, well, hang on, I'm paying tax on $111,000, but I've got no money in the bank. Where's all the money gone? Which is exactly what this particular client was saying to me. I'm actually, they were saying, well, we're actually broke. We've got no money in the bank. We've got work coming in. So there's cash flowing, but it's cash in, cash out, cash in, cash out, right? But the fact of the matter is your profit and loss statement does not show drawings. So when you take out $150,000 of the drawings that the owner had, well, they actually made a $38,000 loss. And so, but you're going to pay tax on $111,000 because that's what you paid yourself. So this doesn't work, as a business. This doesn't function. This isn't sustainable. And this particular business was smart enough to know this can't keep going on. We've got to make some changes. So, we start working with them in this year here, and we say, okay, well, what do we need to change? First of all, your efficiencies. Work's got to go out the door faster. Okay, so we worked with them for 12 months, and you can see here their efficiencies dramatically improved. So instead of 34% labor cost, now we're down to about 28% labor cost. It's not perfect, and we've got, when we work with a business that's been doing something one way for a long time, it's going to take longer than a year to get the whole thing to get to be excellent. But that's a very significant improvement. You can also see here that when we worked with their pricing system, we got the material cost from 42% down to 36%. Again, these are big numbers, right? Because your labor and your materials are your two largest expense in your business. So you can see here, if we're spending, $602,000 every year on materials, and we've just saved you, 6%, that's a very significant savings, and that goes directly onto your bottom line. So we can start to see here how the numbers start to make sense just on being more efficient, in other words, work going out the door faster, and getting your pricing under control so that you're not overblowing material costs. Those two go hand in hand. But as we go down the list here, you can start to see where they weren't investing previously in marketing. They decided they needed a steady revenue source. So we'll go back up to the top here, and you can see here that we added a revenue source from domestic renovations because they knew that working with builders is like riding a roller coaster. It's up, it's down, it's up, it's down. These numbers are showing numbers, but they're not showing the fact that when they ended the year on this year here, they had about $110,000 owing to them from a builder because builders tend not to pay very well, right? So they knew that they needed to get cash flow, work that would pay on time. So marketing stepped in, and we dramatically improved their marketing results and started doing domestic renovations. We also added to the scenario a flat packing option. So this alone brought in some additional revenue that immediately put money in the bank. And that all came from a very simple $18,000 investment over 12 months. And if you look at the percentages here, these percentages are important because if you're going to invest in marketing, it should not be any more than 3 or 4% of your revenue. This investment for them, because the revenue went up so significantly at the end of the year because of the marketing, this percentage ended up being around 1%. But at the beginning of the year, if you were to look at the percentage, it probably would be 3 or 4%. So it is an investment that you need to give it time to pay off. The other thing they hadn't invested in was any professional development, any learning or learning how to do new things. As you can see here, 0 in the year before and all years prior to that. All that would happen is they would struggle with business and say, I'm struggling with business. Next year, rinse, repeat. So once they learn how to do new things and they invest in that for themselves, the return is going to be very obvious. So you can start to see here, there's a few things I've highlighted in yellow that are new things. But the other thing that dropped with marketing, and particularly with the way that we do marketing, is we make recruitment part of your marketing strategy. These guys were paying an enormous amount of money in recruitment. And it was just this churn of employees that would come in, wouldn't work out, and would leave. And recruitment strategies tend to work like that sometimes. Whereas when we actually use marketing to attract great people to your business the right way, then then marketing really becomes like finding great clients and finding great employees. It's the same thing, right? You want to find the right people. So a major deduction in the investment in recruitment. And like everything, rent went up this year. But there was also, when we went through their numbers forensically, we found that they were overpaying on their rubbish, and most people are. So I would recommend anybody watching this right now to forensically go through your rubbish, your tip, your bins, and negotiate a better rate, because you're probably paying too much. We can also see here that we negotiated a better rate for their phones. So there was some savings there. They were paying a website maintenance designer that was actually doing absolutely nothing. So we completely got rid of that. And you can see the results here. We also put the owner on wages and a dividend payback at the end of the year. So what this means is net profit went from 7.7, but in actual fact it was 0 because drawings came out of that. This year, with all of that investment of marketing and professional development, which brought in more revenue, the actual net profit has gone up to 15%. And that was only in 12 to 18 months. And that happened because this particular client was very, very, very dedicated to making this happen, because they knew if they go for another year or two, the business is done. Because you can't keep running a business and making a loss. Numbers will just say you're done at some point. So what we're projecting forward this year, and we are, I hate to say it, but we're well into the current year. So these numbers are very, very likely to be true. You'll see some of these numbers are rounded over because they're projections. But the difference this year is we have a significant revenue increase. Again, let me go back up to revenue. Significant revenue increase from 1.66 to 2 million odd dollars. So significant revenue increase this year. Again, we've gone from 6 employees up to 12 employees. You can see that the wages has gone up, but the actual percentage of that revenue, or the percentage of the wage against revenue, has gone down. So our revenue's gone up, our wages have gone up, but the investment in the wages is paying back more. So we've gone from 33% left over to a 40% net profit, gross profit percentage, which is something we're going to have to work on towards the end of this year. This will end up landing around the 33% mark because we think some of these numbers will change even more. But the other thing that's significant is they have actually increased some of these costs. So accounting goes up. When business increases, your accountant just tends to pay, ask for more money. It's just the way accountants are. And the other thing that happened is they dialed up their marketing. So they said, well, $18,000 investment in marketing was pretty good, but they went to another package from the marketing joint and got even more return on their investment. Professional development, again, they invited us to not only just be their business coach, but actually be training people on the factory floor. So that's going to pay off not only in this year, which we're halfway through, but it'll pay back again next year with those efficiency gains again. So the other thing, and I've got some little numbers here that says this was a plus, but this was a negative. So in other words, we looked at hire of equipment and reduced that. But heat, light, and power went up. Unfortunately, it went up for everyone. Motor vehicle expenses went up. So a lot of these expenses on the expense side of things has gone up. And that's just the way this year has gone, right? So you'll see that. Now they did actually extend their factory into the next building next door, like just through the wall. So their rent has gone up. But again, when you compare that against revenue, the rent last year, even though it was less, was 2.25% of the revenue. Even though rent's gone up dramatically, it's still only 2.5% of their revenue. So rent went up, but from a revenue percentage, it stayed exactly the same. And that's the important thing, right? Is your costs, if your costs go up, so should your revenue. So as you can see here, we've got a number of things that went up, and that's, I'm just proving that not everything can go down. Sometimes, as you know, costs go up, which is really the conversation a lot of people have. Everything's going up, everything's getting more expensive, and everybody seems to have this mindset that that's making your business get worse. I'm demonstrating for you here in these numbers as how that's really not the case, because there needs to be an offsetting benefit to all of this. So this year is actually looking very, very, very healthy. So we're projecting about a $560,000 net profit in business, which is projected to be around 24%. Now that's a significant shift in the profit percentage of the business. Now, I wanted to just also share with you a little bit of a thinking sheet, because I talked about your investment. So if we look at this business and we go, okay, this business had these revenue results in these 3 years. Okay, so these are the revenue. And we look at the hours that a business works. And on average, a business like this would work about 1,976 hours per year. So we divide that by the revenue and we say, okay, this business has to be taking in $736 per hour to be viable, or to get that outcome that they got. 840, and as the revenue goes up, obviously the revenue per hour goes up. So that's a little calculation you can sink your head into. And then we just look at the marketing or the investment that you might think about in your business. What investment have you made in marketing? In this case here, this business in the first year had made no investment in marketing, so there was no return. In fact, you could call that a negative, because if you're not getting a return, you're probably getting a negative. They hadn't invested anything in their learning, so they didn't get any better at anything, and the business kind of was likely to stay the same, and which means it's getting worse. So there was no return on the investment because there was no investment in learning. But if we think about the hours, so when you think about hours in business, what we know is that a lot of times the hours that you think it's going to take a job to be done, when the job gets done, they become way more hours than you actually originated. So if you estimated it was going to be 50 hours to get a job done, and it takes 60 or 70 hours, that's the overwork hours we're talking about here. So with this particular business, we found in that year they did 58 jobs, and on average, obviously some more, some less, that's what an average is, but on average they were about 18 hours on every job over what was estimated, right? So we take 18 and we divide it by the number of hours, or the money that it takes to run this business per hour, and you get either a gain or a loss. So the fact that they are paying people in this year in total 1,044 hours. These are very conservative, by the way. There was probably way more than this, but 1,044 total hours in 12 months. And the cost of those hours is something that the business is investing in. Every single time that an employee is working an hour that isn't allocated against your estimate is an excessive investment from the business that gets no return. So the calculation is that cost this business around $768,000 that year in excess work being done that wasn't allocated or estimated to be done. So, 50 hours estimated, 70 hours to do the job, right? So when we start getting tighter with things and the business starts getting better, like this business did, the next year saw them doing 73 jobs, more revenue, but we were able to really claw back the over hours. And again, this is a progressive thing, right? So 73 jobs, and we got the number down from 18 hours on average over down to 7 hours per job, which still means 511 hours as an investment in the business to get no return. In fact, it's a cost. So the cost of that 511 hours, but keep in mind the previous year it was 1,044. So we've actually made a very significant gain. Not that gain, there's a number mistake there, but we've made a very significant gain in what's actually happening here. I'm just going to say there's a gain here to be made because the previous year was 1,044 and this year was only 511. But still, there's an investment being made here that is giving a negative return. It's a cost. It's like going to the casino and investing in a bet and you lose. Well, what did that cost you? Whatever the bet was, that's what it cost you. So they are paying people to go off and fix work that they're not getting paid for. So that's an investment that is hurting them to the tune of about $429,000 the second year. Now, if we look at the third year where we've got significantly more revenue, and obviously the per hour rate is higher because more revenue divided by the same number of hours the business is working means the business has to be making and bringing in $1,171 per hour for it to have this revenue. Now, how are we going to invest that money? Well, we invested in more marketing. And if we look at year 2, the investment in marketing was $18,000. And the gain of work brought in another $26,000 worth of work. That's a very worthwhile investment. The learning that this business did cost them $36,000. That was our program. But it brought them $260,000 in extra revenue, just simply in the efficiency gains. Year 3 is a $23,000 investment in marketing. But now, because the marketing has a foundation that is now going to build on, now marketing can start growing exponentially. So that return is now $160,000 off marketing. And this company decided that they were going to invest more in their learning with us. So their return now went up to $300,000 on a $42,000 investment. So if you think about what you invest your money in or your revenue in the business in and what it gets you back, this is demonstrating the returns and how you can actually afford to raise your business levels. But you can see here also that the focus on the over hours worked. In other words, if you've estimated 40 hours, it should take you 40 hours. This year, we actually project that because we didn't make a significant change in their pricing system, in how their hours are being calculated, but we've become dramatically more efficient, the work is actually going out the door significantly faster, which means we're actually projecting if we leave things as they are, then they're going to have a 4-hour per job excess. In other words, a gain of 4 hours per job. So what that means is 108 jobs projected to be done this year times 1,171 means this business stands to make, on the investment of getting to this point, stands to make another $505,000 just in committing to not going over on all their jobs. In other words, getting the jobs done on time in the time they've allowed and moving on to the next one. So that was a really quick little snapshot of how you can look at your investment, and with us, particularly with the Joinery Coach. If you were wondering, certainly not, this isn't what it looks like when we work together, but this is how the costs can work for you. And that's a typical, I've shown you a typical client. That's not exceptional. They're not better than the others. They're not worse than the others. That's about an average result with a client with us. Hopefully that gives you a little bit of insight as to how you can actually afford to get the help you need. And where it actually comes from. An investment is something that will get you something into the future. It's not something, if you were to assess, can I afford this right now? You might not be able to afford it right now. But the question is, can you afford not to do it right now? Can you afford to keep running the business as it is and getting the results you're getting? That's a better question. Can you afford to do that? So if you'd like to have a conversation about this, or if you'd just like to figure out if we're actually legitimate or anything like that, jump onto our YouTube channel here and see all the clients that we've been working with. But I've just run through the numbers to show you typically how it could work for you. Obviously, your numbers will be different to the ones I've shown. Yours might be better. Yours might be a little bit worse. But the bottom line is there will always, always be a return back to you in working with us. That's how you afford it. It's simply an investment that gets you a return. Whereas you're probably investing in a lot of things in business right now that are not only not getting you a return, they're making a loss for you. So, love to have a conversation with you. Jump on our website, thejoinerycoach.com, book a chat. It's not a sales call. If you just have some interest in what I'm talking about here, or put a comment down below and I'd love to answer some questions. Hopefully that's been helpful, tweaked your interest a little bit, or answered some questions. All right, Bruce from the Joinery Coach. Have a great day. We'll see you soon. Cheers.